My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends? I'm just trying to help you make some money. My job is not just to entertain, but to educate you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. But we can bemoan the economy. We can worry about housing. We can fret over mortgage rates. We can debate when and if the Fed will cut interest rates or not. We can rue the day big institutions discovered the yen carry trade. We can gamble on whether our country's headed for a recession. Or we can overlook that whole shooting match and just pick the stocks of tremendous companies and hold them for the ride of a lifetime. Unfortunately, the former set of woes controls the discourse right now. Sometimes that's good, like today, where we got an encouraging jobless claims number this morning, and then the averages roared, with the Dow gaining 683 points, S&P jumping 2.3%,
House of pleasure,
and the Nasdaq surging 2.87%. The usual growth suspects, the Magnificent Seven, particularly Apple and its suppliers, were suddenly able to free themselves from the shackles of gloom and rocket higher. It was the best day for the S&P 500 since 2022, and big cap tech led the session. But have the sellers truly disappeared? For the moment, maybe. But stock prices have become so dependent on the macro data, the carry trade, the Fed chatter, that it's impossible to give you a pat answer, even as I've told you over and over and over again, that corporate America is doing much better than anyone would expect at this point in the cycle. Now, I do know this. Many people correctly now recognize that all stocks live under the tyranny of larger macro forces. Before we decide to buy something, we're supposed to think, we need to, what's going to happen to interest rates today? I mean, if they drop a bit, mortgage rates today, if they fell to a 15-month low, isn't that why the market really went up? Well, there'll be more housing turnover. Well, there'll be more rehab and remodel, especially do it yourself. See, we try to divine if a quarter-point decline in the Fed funds rate will motivate people to buy new cars, maybe boost GM or Ford, or perhaps we just buy an ETF that gives us a piece of economic oomph, some sort of phony industrial amalgam put together to earn fees for the promoter. We mold the notion that there could be a pickup in semiconductors if the economy accelerates, so we buy an ETF that has semis rather than just going after NVIDIA for AI or Texas Instruments for the Internet of Things. That is the world the big institutions deal with. A trading-oriented, short-term guessing game based on the data point of the day, a style that so many now find irresistible. If you're not careful, their thinking becomes your thinking, and you get blinded not by the light, but by a very dim bulb. On Mad Money, I like to approach things very differently. I don't want to be bound by the four walls of the PMIs, the PPIs, the PCEs, the GDPs. We don't want ETFs where we buy the bad along with the good. And we certainly don't want to worry about every tick in interest rates. We don't want to be blinded by that. And you know why? One, because that's a sucker's game. You're letting the macro control your thinking, just like the big boy hedge funds. You're checking your brains at the door. But two is Eli Lilly. This morning, Lilly reported a quarter with $11.3 billion in sales when Wall Street was only looking for less than $10 billion, while raising their full-year sales guidance to $46 billion, full $3 billion above expectations, in large part thanks to these wondrous GLP-1 drugs. Oh, it was a tour de force quarter, one where they highlighted so many different indications for Mounjaro and Zepbound, those are different versions, same stuff, that you have to believe your insurance will cover it. The results are so good that the insurers genuinely may not have a choice, even if they need to pay through the nose for this stuff. Lilly's results had nothing to do with mortgage rates or J Powell or drug ETF that might have capped your gains if you chose to play it that way. Much better to just go with Eli Lilly, best of breed, which has been the obvious one for quite some time. It's not like nobody saw this coming. If you went with best of breed, you were up 9.5% today. Now, I know this morning I was very concerned that Lilly could miss numbers. I tweeted that around 4 a.m. after the disappointing earnings we got from Lilly's sole competitor, Novo Nordisk, yesterday. I knew that Lilly's drug causes you to lose more weight than their rivals, but I also knew that the expectations had gotten so high that the stock had been acting so terribly that I figured there could be something else afoot. But you know what? I chose to stay the course for the Charitable Trust because of my faith in CEO David Ricks and the company that is Eli Lilly. My faith was rewarded, not only with a blowout of incredible proportions, but also with a series of statements from Ricks that nullified so many claims from Lilly's aspiring competitors, often promoted by charlatans on right here. and how they're working on better GLP-1s. Right now, they're up against Lilly's competition. Lilly's anti-obesity, anti-diabetes drug is a once-a-week self-injection that doesn't hurt. But there are commercials on air that make it look like it hurts like the dickens. Lies. We know that one competitor says it is experimenting with the GLP-1 drug in pill form, not a shot. Well, so is Lilly. We know there's a competitor with the GLP-1 that can inject less frequently. Lilly's working on that, too. We know that there's a competitor with a pill or shot that's targeting only fat and not all body mass. Well, you know who else is working on that? Eli Lilly. But what many learned today is that Lilly's ahead of everyone in this business. And in this business, let me tell you what happens. The tie goes to the incumbent. The FDA isn't going to bless lots of products from competitors faster just because it's worried about antitrust. They don't care about antitrust. That's a different branch of government. And Wall Street isn't schooled in the process of drug trials and drug approvals. These people pushing these rivals don't understand that a company that doesn't have much of a reputation with the FDA will have a harder time getting something approved. And some of these smaller operators can't afford that delay. After the Lilly call, I realized that there are so many trials going on for so many indications that even up this much, the stock might not be for sale. It may still be able to go much higher, especially when Rick's talked about how only Lilly has the manufacturing scale to make enough GLP-1 drugs to meet the demand. Lilly is committed to building more than $20 billion worth of facilities or upgrading them in the U.S. and Europe. No one else can afford to spend like that. So you have a company with a revolutionary drug that has multiple indications, a drug where they have both the lead in all formulations and the scale to stay as the top dog. We just have to hope that the Justice Department allows them to benefit from the billions they poured into the franchise rather than penalizing them for being so far ahead of the competition. I think they're less likely to be targeted than the big techs this administration loves to go after, because without patent protection, no drug company would ever develop anything new. Look, today was a very good day for everything. It's a day we'll look back on maybe 24 hours from now and perhaps say, hey, you know what? We're done with the detritus of the yen carry trade. Maybe it's the day where we restore the dethroned Mag 7. Whatever you want to say. Maybe even the bedraggled NVIDIA can come back to life. But the bottom line, I just come back and say that if you pay attention to the real world, you may find yourself taking a GLP-1 and want to buy the stock of Eli Lilly. But if you pay too much attention to the financial world, you might have convinced yourself that this stock wasn't worth owning thanks to the fallout from the yen carry trade and the collapse of the state of the economy. The all-holy macro would led you astray and kept you out of this terrific gain. That's why I like to find the best companies for you with the best stories for you and just stick with them through thick and thin. Let's take calls. Let's go to Kior in New Jersey. Kior.
Hey, Cramer, how are you?
I am doing well. How about you, Kior?
Pretty good. A quick question. I hope, first of all, my son is watching this, a teenage son. I always encourage him to invest in early age. But here's my question.
Okay.
Deckers Outdoor, DECK. What's your thought on this one, especially for long term, say 5 years?
Well, I have to tell you that these stocks are fashion. And fashion goes in and out. That said, I think Deckers has at least another year in it, but I can't say 5-6 years because it is fashion, and fashion is not sustainable. How about Richard in California? Richard!
Hey, Jim, how are you?
I am good. How about you, Richard?
Good. I've talked to you maybe a few times in the past year and a half, and I just had to call in and Paul revere the stock one more time. I just got off the earnings call of this company. It's amazing. Enormous growth in all their metrics. Their core business is growing fast from insurance companies sending patients out of expensive hospital settings to outpatient centers. Company developed AI in detecting cancer is an absolute game changer. The United Kingdom has their AI in use for population health, and the soon will enter the U.S. It's hard to imagine what this will do to the growth of the smaller company. Their AI will be licensed and sold endless healthcare companies in the U.S. In 35 years of investing, I've never seen such a great investment as RadNet.
High endorsement. What is the stock?
RadNet.
I didn't hear the stock. RadNet. Okay, RadNet is a very good company. We've had them on. I think the world of them. I bought for my Charitable Trust. I bought GE Healthcare Technology, which is not nearly as good as RadNet. It just happens to be cheaper. I agree with you that it's quite a good story. Let's go to Bob in Florida, please. Bob.
Jim, this is Bob from Florida.
Hey, no.
I'm a founding member of the club.
Oh, excellent. Thank you. Thank you very much. Big meeting next week. Don't forget. We'll have a monthly meeting.
I will.
Okay.
I own shares of Schwab, and I've been losing money on them. Should I keep them, or should I use the money elsewhere?
Which stock? I'm sorry? Schwab. Okay, I happen to like Schwab very much. They came on the show, Mr. Bettinger told a very good story. I know that there's short-term considerations. I think they will go away. I think it's a good level. I would buy the stock of Schwab. I buy half a position here and then half position when some knucklehead analyst downgrades it again, because that's what they tend to do. Look, I like to find good stocks and good companies with good stories. That's how you avoid being swayed by the financial chatter and make smart investments instead of going in and out and in and out like some sort of hedge fund joker. On Mad Money tonight, Dutch Bros stock is sinking if the company gave a half, let's say, call it a cup half empty outlook for its store count. But what else was in the quarter that investors may have missed? I've got an exclusive with the CEO. Then we're hearing the consumers feeling some tightness, but then why are the food delivery apps still putting up solid numbers? Aren't they expensive? I'm taking a closer look at the sector, taxes and fees included. And as people return to non-urgent medical care after the pandemic, I'm taking a look at one medical device player benefiting from the uptick in procedures. So do not miss my exclusive with Zimmer Biomet, and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, we got a bit of a mystery to solve here. What the heck just happened to Dutch Bros? That's the Oregon-based coffee chain that saw its stock plunge a staggering 20% today. This is nuts. Last night, Dutch Bros reported a very strong set of results, higher than expected revenue, same-store sales earnings. But, and this is apparently the biggest but you've ever seen, management left its full-year same-store sales guidance unchanged, which indicates that maybe the second half of the year will be slower than we'd hoped. On top of that, management said new store openings will come in at the lower end of the previous guidance, which is something that I've actually called for, but maybe for different reasons. Doesn't sound like something that would knock the stock down 20%, does it? But don't forget, Dutch Bros still hasn't even fallen back to where it was trading before it reported a blowout quarter 3 months ago. So let's get a closer look with Christine Barone. She's the president and CEO of Dutch Bros to get a better read on the quarter and what comes next. Ms. Barone, welcome back to Mad Money.
Thanks so much for having me again, Jim.
Okay, so Christine, let me ask you, because no one's been a bigger fan in the media of your chain than I am, both as a customer and also the stock. And I found myself thinking, if Christine had a do-over, would she do the call differently? Because it didn't really reflect, I think, the fundamentals of the company.
Yeah, look, I think that we need to be super clear about our confidence in our future. We are building this company for the long term. We're doing the right things for our broistas, for our customers. We had an awesome quarter. I think we beat on almost every dimension. We raised our revenue guidance. We raised our adjusted EBITDA guidance. And, I think as we talk about the business, we want to be really clear about the things that matter most. As we look ahead, we are on a path to 4,000 shops. And, one of the things that maybe didn't come through as clearly on the quarter is we actually saw a bump up in new shop productivity, which is really important to our growth, right? So as we look at the AUVs, as we continue to grow of our new shops, how many customers are coming to those new shops, we saw a really nice bump up in that number. And that's about our long-term growth and where we're going in the future.
But also, that would be about, look, these analysts, there were 6 analysts who seemed befuddled or were kind of just begging for you to say, look, give us some definite number for the second half, or otherwise people are going to presume the worst. And Christine, judging by the action in the stock, I think people are now presuming the worst of your company.
Yeah, so as we look at the second half of this year, we did keep our comp guidance exactly the same as we'd had it before. And the reason for doing that is if we look at the second half of the year, we're actually coming off a fair bit of price as we go through the year. The second thing that we're seeing is we are seeing an external, pretty intense promotional environment out there. So as we go forward, we're continuing to react to that. We want to make sure we are always providing awesome value to our customers. We've been doing that through our rewards program. I think you might remember we have a super healthy rewards program. 67% of the transactions go through that program. And we want to be able to provide that same level of promotional activity, reward customers for coming in to see us.
Now, you did say you're going to have to do some advertising. It was discussed. Advertising can be very expensive, and you're in a group of regions where it might be difficult. You can't do national advertising. How are you going to approach those different regions? How are you going to approach new area, Florida, or the huge number of shops you put up in Texas?
Yeah, so a lot of the digital media that we're doing right now is really personalized, and we can even personalize by zip code. So we are going after customers that are in those new markets. We're finding them on Snapchat, we're finding them on TikTok, and we're just introducing them to our brand. I think one of the things that might be underappreciated about us is we're at 912 shops now, but have added almost 500 of those in the last 5 years. So really rapid growth, especially in some of our new markets.
Now, I did ask previous management, I said, listen, I wish you could slow things down. This was when the stock was in the 40s, because you never know whether you're going to have enough cash to self-fund. They assured me it wouldn't be a problem, and then the stock broke down because they did have to finance. They did have to offer stock. Now, I know that you are slowing the growth of store change, but not by a lot. But is that because you're trying to be prudent, or are there other things that I'm missing?
No, I mean, we took literally a handful of shops out of the pipeline for this year. And as we look at that, what we're seeing is we are seeing increased new shop productivity as we go. And we have refined and recalibrated our real estate models. So what I can tell you now is I'm super confident in that we know when we open a new shop about what that AUV is going to look like going forward. We also have a concept we call sales transfer. So as we open new shops, sometimes customers move between those. We have great estimates on that. So as we have awesome new numbers that we're looking at, it's really important that we're adjusting those numbers and looking at, would we open every single one of these sites? Are they the absolute best sites we can open? Because we are on a long path. We have a lot of great sites ahead of us. We need to be opening absolutely the best sites for our Broistas and our customers.
Let's go back to that promotional environment. I know that most of your business now is cold. Is this Starbucks? Is it Dunkin'? I mean, who's out there in a price war? Because my lattes cost just as much as always.
Yeah, I think what we're doing with our customers is we do have a very strong cold business. Over 90% of our beverages were cold in the quarter. And, you know, as we look at what we're doing, we think we're uniquely Dutch Bros. So we have a really strong energy business, which I think is unique in the market. We're providing great innovation to our customers. We launched protein, we launched boba. We're on the path to launching mobile order right now. So we don't have order ahead capabilities in most of our shops right now. But we shared on our call that at the end of July, we have almost 200 shops now with order ahead capabilities. So that's marching forward as well.
All right. One last question. After last night's call, which is quite different from the interchange you and I had, would you ever just say to the analyst community, look, from now on, we're just not going to provide guidance. We're just going to we're going to do something different. We're going to tell you what we're up to. Because I felt it got a little antagonistic in the end, because there were people who wanted something you weren't going to give. And that caused some of what I think was an antipathy to the stock today that maybe was undeserving. Is there a way to be able to communicate to the street, look, we're not going to do what the other guys do?
Yeah, look, I mean, I think that we wake up every day and reflect on what we can do better the next day. That's part of who I am. I think that's part of who we are as a company. So I'm not sure if we're going to necessarily, change our approach. I think we'll still continue to give guidance to the street, but we will be thoughtful about how we communicate everything.
Okay, I think that's very valuable, because I think the stock would not have been down as much as it was, given the fact that the fundamentals are very strong here. I want to thank Christine Broen. She's president and CEO of Dutch Bros. Thank you for coming on, Christine. I really appreciate it.
Thanks so much for having me, Jim.
Absolutely. Mad Money will be back after the break.
Coming up, as consumers tighten their belts, one group stands out. Why delivery is dominating. When we return.
We keep hearing that consumers are cash-strapped and pushing back on high prices. But like I told you last night, it's not that people have stopped spending on everything. It's that they've gotten more selective, always searching for the best bargains. And we've seen this from restaurant after restaurant. Yet somehow, last Thursday, DoorDash managed to report a spectacular quarter. DoorDash, the borderline extortion online food delivery service that we all adore, or at least I do, and it's my show, is looking pretty interesting. The stock shot up 8% the next day, even as the market melted down. By the way, we heard the same thing from Uber. Their Uber Eats business is on fire, which helped that stock to rally 11% on Tuesday. Later that same day, Maple Bear, the parent company of Instacart, reported its own excellent set of numbers, allowing the stock to gain 3% yesterday. Now, it doesn't even matter that Maple Bear is a ridiculously stupid name. All the better to get the word out, I guess. These online delivery services may be convenient, but they do offer what I regard as terrible value. So how the heck are they doing this well in an environment where the consumer is supposed to be rebelling against high prices? Why don't we start with DoorDash? Last Thursday night, they surprised to the upside with better than expected numbers for every key line item: total orders, gross order volume revenue, and contribution profit. DoorDash delivered 23% revenue growth, while with rising margins translating into strong earnings for interest, taxes, depreciation, and amortization. Plus, management gave you very healthy guidance for the current quarter, substantially better than expected, especially on the earnings front. How they pull this off? On the conference call Q&A session, that was the first question posed to co-founder and CEO Tony Xu, because it seems crazy that DoorDash is doing great when restaurants are seeing softening demand all over the place. Xu pointed to two main factors. First, he explained that digital ordering is still in its early innings. Even though restaurants may be struggling, digital remains a huge source of growth for the industry, even if they're hobbled by lower in-store traffic. He's confident about this because even as DoorDash digital penetration is still in the single digits, and outside of their network, it's even lower than that. Incredible. Second, Xu pointed out that DoorDash's service continues to improve. In fact, order frequency and customer retention are just as strong, if not better now, than they were during the pandemic when you were locked in at home. Plus, he noted that DoorDash has the lowest cost logistics network in most places in the United States, and customers are desperate to sign up for their Dash Pass subscription, where you pay $9.99 per month to get delivery fees waived for orders over $12. I think there's one more key driver here, though, which is that many people got so used to the convenience of these delivery apps during the pandemic that they're now seen as a necessity. Yet this looks like a lasting behavior change from the pandemic. In fact, people paying up for food on DoorDash could be a major reason why they have less money to buy everything else. Either way, this company is doing great. And Xu, what can I say? He's a fabulous executive, and he's great friends of the restaurant industry. Or now, how about Uber? Well, it was over a great quarter. It was just a great quarter overall for the company. But right now, I want to focus on just one segment, which is called Uber Eats, where gross bookings grew by 16%. Revenue came in a little light at 8%, but EBITDA expanded by 79%, coming in much better than expected. Their guidance for the current quarter was also solid, although also slightly lower than expected. Give them a break. When Uber CEO Dara Khosrowshahi went on Squawk Box on Tuesday morning, he had a lot of interesting things to say. For one, he pointed out that his business has a counter-cyclical element, because when the labor market gets weak, more people want to drive for Uber and Uber Eats. That helps improve the service, because when they have more drivers, the users get shorter wait times and better pricing. But in terms of Uber Eats, Dara explained that deliveries become a sticky habit, for the consumer. And at the same time, while the prices are high, you get a much better deal when you sign up for an Uber One membership, which gets you 0 delivery fees for Uber Eats. He says over half of the delivery volumes come from members. So like with DoorDash, online delivery is only extortionate for the people who don't pay a small monthly subscription fee. On Uber's conference call, the CFO actually said he was surprised to see just how sticky the food delivery business has become. And it seems to be getting even stickier. Listen to this, quote, "I look back 5-6 quarters of data, and it gets better every quarter in terms of eater retention," end quote. Pandemic habit, convenience means more time, and post-COVID time is now the currency of the realm, not so much money. Finally, let's talk about Instacart. I'm Maple Bear, which I haven't been following as closely, is because the stock hasn't had much going for it since it came public last year, and because it's hard to take a company named Maple Bear seriously. A great name for a stuffed animal, though. All right, this was a solid quarter from them. Instacart's gross transaction value grew 10% year over year, better than expected, with total revenue up 15%, also very good, and 89% EBITDA growth, just terrific. On top of that, management gave you robust guidance for the current quarter. In its shareholder letter, Instacart noted that roughly 25 million people used their service over the past year. And the company said that this gives them, quote, "a tremendous opportunity to deepen engagement with infrequent customers while continuing to attract more new users to Instacart," end quote. Well, it worked. Well, you know what? I'm still taking a bit of a wait-and-see approach to Instacart. That's been my attitude since the IPO last September. And by the way, you haven't missed anything. Stock's down almost 5% since I told you to steer clear 11 months ago. I think the grocery delivery business is a tough market. No one's been able to achieve huge success here, even Amazon with its Whole Foods subsidiary. People are used to ordering meals like they order food from a waiter at restaurants. But most of us still prefer to buy our groceries in person, especially if you're shopping for meat or fish or produce. You know, I like to feel the stuff. That said, even Instacart's putting up extremely solid numbers, so clearly millions of people appreciate this convenience. After looking over these strong results from DoorDash, Uber, and Instacart, I keep returning to one thought. It's the fact that meal delivery seems to become an ingrained habit during the pandemic, heck, even before the pandemic. but especially during the pandemic. Both DoorDash and Uber called out the things like order frequency and customer retention are not just holding up, they're actually improving. More important, people seem to see delivery as a necessity rather than something discretionary, which is why these companies can put up great numbers when the restaurants are struggling. Oh, and they know that restaurants mark up liquor ferociously. So it's much cheaper to chow down at home, crack open a cold one, put the Olympics on your 70-inch screen, and never leave the house. Sure, all three food delivery companies called out the fact that customers are prioritizing affordability, and they're trying to give the people what they want, often via membership programs that remove delivery fees, and that's important. But the bottom line, DoorDash and Uber Eats and Instacart can only put up numbers like these because food delivery has become a calcified habit for so many consumers. People who value their time as much as they value their money. No wonder people don't have excess cash to throw around. They're spending it all on DoorDash. Jihan in Florida. Jihan.
Hey, booyah, Jim.
Booyah, what's up?
Jim, I have my son Jian here who has a question for you.
Sure. Why not? Booyah. What do I think of Costco? Oh my! With the gold bars in the morning, with the unbelievable bargains, the 3,000 different shopkeeping units. I tell you, that stock, which had a great month last month, is a buy. And Jian, let me tell you something. Your kid, highest compliment. Got horse sense.
He is the kid.
Oh, he's the kid. Jian's the kid. Hey, Jian, you got horse sense there. I got a little confused between the parent and the kid there. All right, Bob in Illinois. Bob.
Yes, sir. I've been a holder of Kava for quite a while. Lately, it got up to around 80, and then it's really been fluctuating in large increments, like 3 and 5 points a day. Do you think this is a good time to get back in?
Well, I'd like to hit it on a day when it has a big downdraft, because exactly what you said, it has these bizarre moves, and maybe you can get in. I mean, Sweet Green just reported a terrific number tonight. That's going to send Kava up tomorrow. So let's be careful. Don't buy it on an up day. Buy it on a down day. Michael in Arizona. Michael.
Hey, Jim. I hope today's been treating you well.
The day has actually been a fair, I went to Eddie, I got a good haircut. Sometimes that can make a day. It's like a vacation for me because you don't have a lot to do when you're there. What's up?
Hey, so I've been looking at the consumer discretionary sector, especially following Chipotle's 50-1 split in June. And because their fundamentals still look like they're intact, is Chipotle looking like a buy, sell, or a hold, Jim?
I think when Brian Nickel came on, he put to rest that whole notion of smaller sizes, which was all a canard. I said to myself, these guys are back. Now, the one thing that you have to recognize is that this stock sells at 50 times earnings, which is high. But I have been backing Chipotle since, I guess what it would, well, let's say for 85%, because that's how much it was down when they had that terrible food scare. I don't want to call it more than that, because there, by the grace of God, every single restaurant could have had what happened to them. All right, food delivery companies have said they're prioritizing affordability, but I think the real stickiness here is because meal delivery is becoming ingrained in consumers' lifestyles, and it gives them more time. That's why they can keep putting up these great numbers, and why they I think they will continue to do so. I like all three. Hey, much more made money, including my suit with Zimmer Biomet. This medical device maker's stock has been less than exciting, even though I think their products, especially their new products, are very impressive. I'm getting the latest with the CEO and find out if there's more to the story. Then sometimes your stock is only as good as the sector it's in. I'm giving you some examples and telling you how to react when that becomes the case for one of your favorite holdings. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. This year, many Americans have finally been getting the health care procedures they need that they put off during the pandemic. All sorts of what we call non-urgent surgical stuff. That's been great for the hospitals and most of the medical device makers, but not all of them. And that means something's wrong here. Take Zimmer Biomet. It's the leader in hip and knee replacements. It's expanded to orthopedic robotics and mixed reality devices for the operating room. Even though Zimmer is some of the best tech you'll ever find in the industry, this stock's actually down 11% for the year. Even when the company reported a really solid quarter yesterday, the stock fell more than 3%. 5%, primarily because Zimmer only reiterated most of its full-year forecast and even lowered its sales outlook, but it was about currency. So what's holding the stock back? Maybe you're getting a great buying opportunity here. Maybe I'm missing something. I don't know. Let's check in with Yvonne Tornos. She's the president and CEO of Zimmer Biomet to get a better sense of the quarter. Mr. Tornos, welcome to Mad Money.
Great to be here. Thank you for having me.
Well, this is very exciting to have you because there's really, I regard it as two Zimmer Biomets. There's stuff that we all know, which is the knees and hips, and then there's the stuff that you're doing now. And I just want to give you the floor to talk about what I think is one of the most exciting, actually in-use reality devices that I've ever heard about.
Yeah, we have been around for 100 years. We are known for our knees and our hips, #1 company in the world in knee reconstruction, #1 company in the world in hip reconstruction. But we do much more than that. We have leading robotic applications in reconstructive, but also in brain procedures. We are the #1 company that treats epilepsy with a robot that can diagnose and can implant an actual device to help your epilepsy.
And no one really has anything.
Nobody has that.
That is proprietary. A lot of companies have tried to crack epilepsy and have had no luck. But you're coming at it from another way.
We do solutions like mixed reality. Think about a surgery in where your surgeon can have goggles on that sees things that you cannot see. You can see parts of your anatomy. You have a hologram of your actual anatomy. You can see the instruments. You can see where to do the surgery. This means more accuracy. This means a shorter time in the operating room. You get out of the hospital sooner. We do smart implants. We are the only company in the world that can make a fairly dumb device. This is a knee implant. It's been around for 60 years, right? Titanium, stainless steel, cobalt chrome. Now, in this implant, we can put a tiny sensor, Jim, a tiny sensor. We call it Persona IQ, that is going to tell you things about your mobility that you didn't know about. It's going to feed data to you, the patient, to your surgeon, to your care team, to tell you about your recovery. Are you walking the way you're supposed to be walking after surgery? Is your mobility the way it's supposed to be?
This
is transformational.
Now, will I be able to, for instance, team up with this and find out things that I could look, or my watch? My watch, which of course died today because I didn't charge it. Yeah. But I mean, how tied in are you? I know you do Microsoft with Apple.
We have a full ecosystem of solutions.
You do.
We think of us as a solutions company. Every product at Zimmer Biomet either collects data or feeds data to another device. We have a partnership with Apple, in where through an iWatch, to your point, or your iPhone, you can collect data and feed that data also to your caregiving team. Before surgery, tells the surgeon how you move, how are you behaving, what should you eat before the surgery, and what should be the best surgery with the best implant, with the right implant that is going to give you the most mobility.
Now, I'm trying to figure out how this business works. Should I be asking my GP or the person I'd be sent to see whether they have yours? Because I would rather have yours than another company's that has a dumb knee.
Sounds like the right path. You should be talking about your mobility.
Yes.
And there is a personalized plan for every anatomy under the umbrella of Zimmer Biomet Solutions. So I will start with talking about you. What is your lifestyle? Like you're a pickleball player.
Yes, I am. I built a court because I can't move. I can't play tennis anymore. I can't play basketball. I can't run. This is the sport. And my wife is king or queen at it. But this is the sport for people like me. But I'm worried about my knee.
Well, you shouldn't be worried about your knee. We sponsor pickleball. We alleviate pain and improve the quality of life for people around the world. Meniscal repairs is one of the highest frequency injuries for pickleball players. And we can get you back on the court at a time you didn't expect.
But I am so afraid when you say we, that there'll be people watching, they'll go to the hospital, and the hospital won't have your stuff.
We are the #1 company in the world.
So I can just ask
in reconstructive surgeries.
Okay.
We've been around for 100 years, and we're just getting started. So you do know Zimmer Biomet.
Yes. Oh, no, I do. But I'm afraid some people might just say, listen, there's another company. You know, some of your opponents are big companies. Yeah. They may not have as good a product, but a lot of times people don't get the best product in our country. They don't get, or they're afraid to ask because our system's so crazy.
We think about those opponents as peers more than opponents. Our opponent is osteoarthritis.
Okay.
Our biggest challenge is awareness. There are 600 million patients on Earth who suffer from osteoarthritis, and less than 5% do something about it.
Okay, so now we've talked about the things that are really exciting. And what I'm worried about is that people will say, wait a second. He starts out by saying, on the conference, look, we're a 5% grower. I see these things, and I think that that's a baseline, and great things could happen. Am I too bullish about Zimmer Biomet?
I'm bullish as well. We got 50 new product launches in the next 30 to 36 months. We just had an investor day. We committed to growing revenue above market for the next 3 years.
The investor day was like it was like Mission Impossible meets science fiction. I cannot believe what you guys are up to.
I like the way you think about it. But again, revenue above market, EPS, earnings per share, growing faster than revenue, and free cash flow growing 70% over the next 5 years, and returning that to shareholders.
But your price earnings multiple is ridiculously low versus all the growth you have.
Well, I'll leave the discussion to you and others. We're here to do innovation, customer-centric innovation. We're here to control the present and the future. And with this innovation, with the solutions that we have in store, this company is just getting started. This is not the Zimmer Biomet that you used to.
Oh, no. When I heard you were coming on the show, I said, I'm so excited. Well, I'm going to say, unfortunately, because many of my friends are your customers.
Well, I hate to say that, but thank you.
Good enough. That's Ivan Tornos. He's the president and CEO of Zimmer Biomet. Guys, this is an inexpensive stock in an expensive market. Take a look at it. Mad Money's back after the break.
Thank you.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the light round. That's where I quote Rob Farley saying the stock. I tell you buy, sell, just because all kinds of stuff. I say play the sound. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's go to Gary in Texas. Gary.
Hey, Jim, it's Gary in Houston. I've been following you for over 25 years. You're an icon.
Thank you, Gary.
And I just want to tell you that my kids and my girlfriend are club members. And as far as we're concerned, you are CNBC.
Oh, my God. Thank you so much. We have a great team here. Great team here. How can I help?
Just wanted to ask you about a stock, Teladoc. What's your opinion?
Yeah, I don't like Teladoc. Gary, you and your family, I'm thrilled your members, but I got to tell you, what's going on there right now, we've got this Kathy Wood. She sells the stock almost every day. She bought it much higher. It's really painful to watch. Let's go to Dan in Massachusetts. Dan.
Booyah, Jim. Thank you very much for taking my call, man.
Of course. What's going on?
I'm thinking of buying something in cybersecurity, and I like the stock called Fortnite. What do you think about that one?
Fortnite reported a very good quarter. It was great to see. By the way, so did CyberArk. I remain committed to Nikesh Arora and Palo Alto Networks, which I think is doing the best of all of them. Let's go to Nick in Maine. Nick.
Hey, Jim, short-time viewer, first-time caller. You're right more than you're wrong, so you're good in my book, sir.
There you go. That's all I care about. Thank you. What's up?
Let's get down to business, man. I know you're all about it. Innova International.
Innova, a little dicey because it's untraditional lending. I am just a traditionalist. I say go with the stock that collapsed over the last week. Go with Wells Fargo. Dave in Illinois. Dave!
Dr. Cramer, my old mad friend, how are you?
I'm doing fine. Thank you for giving my correct appellation. How about you?
I'm great. On the coattails of NVIDIA today. Holy cow. Jim,
nice to see you go up.
Please remind us why you like GE Healthcare in your charitable trust.
Well, Dave, you know what? I've got to tell you, they did have a decent quarter. They have been hurt by China. I'm not impressed by my own stock being like this. I could have bought GE Vernova. I could have bought GE Aerospace, and it would have been better. I bought the worst of the three, and I'm not proud of myself on this. I think we'll ultimately make a lot of money on it, Dave, but it's been, I'd say, a cross of MRI. Let's leave it at that, but thank you for the call. Let's stick with Illinois. Let's go to Max Illinois. Max.
Bentley Systems, BSY.
Yeah, I know these guys. You know what? Look, this is enterprise software, and there is more money being lost in enterprise software in 2024 than in any other sector. So I can't play. I'm sorry. Let's go to Joe in New Jersey. Joe.
Hello, Mr. Cramer.
Hey, Joe. How you been?
With an earnings beat and a cut in guidance, should I still hold on to Merck and possibly?
No, you should not hold on to Merck. You should buy Merck. I have tremendous faith in what Robert Davis is doing. It, like GE Healthcare, got caught up with China. China will be a short-term concern for a great company like Merck, but it did surprise us. But I'm sure it surprised Mr. Davis, too. Let's go to Carol in Michigan. Carol.
Hi.
Carol.
Yeah. Yep, this is Carol. I'm calling about monolithic power solutions.
Okay, power management data center. Stock was up one of the biggest of all gainers today. I'm going to have to say no. The day to buy it was yesterday. And that Ladies and gentlemen, it's the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, nice place, bad area, the neighborhood headwind holding back some quality stocks. Next.
Sometimes picking stocks is as easy as figuring out the neighborhood a company lives in. If the zip code's a bad one, it might not matter what the company does because the stock won't get any traction either way. Last night we spoke to John Fieldly. He's the CEO of energy drink company Celsius. He reported some terrific numbers, including $402 million in revenue, up a whopping 23% year over year. You normally don't get that kind of growth out of a beverage company. Celsius was on its game. It was responsible for a big portion of the growth in the energy drink category. It didn't matter, though, because the energy drink neighborhood is very shabby at the moment, with Monster reporting suboptimal numbers last night.
The House of Pain.
Missing both the revenue and earnings estimates. Monster spoke about a slowdown in the sector, something that Fieldly felt should not be applied to them because Celsius certainly didn't see a slowdown. Doesn't matter, though. The category-wide slowdown drags down the best stocks along with the worst ones because nothing can escape the gravitational pull of a bad neighborhood. His stock finished unchanged. At one point, it was down $3. We saw the same thing with the beer industry, which is being kept down by fears about GLP-1 drugs, causing a sharp decline in beer consumption that has not occurred yet. Right now, Constellation Brands has seen its stock sink lower and lower for months, even as its beer brands, Modelo and Corona, are taking share all over America. Like Celsius, they're responsible for any gain in the overall beer category. We own Constellation from my charitable trust, monthly meeting next week, by the way, and it can't get any traction whatsoever because the neighborhood's awful. It doesn't matter that CEO Bill Newlands is doing everything right. The stock refuses to stay up because money managers, they've just given up on all things beer. Some neighbors are so bad that a great company like Nucor, arguably the best steel maker in the world, simply can't lift its head because so many grades of steel are rolling over right now. Doesn't matter that they have superior mills and tech. Doesn't matter that they've made some clever acquisitions like CHI. That's an overhead door company for residential and industrial use. Nucor's stock has been down relentlessly because steel prices can't hold. Hey, speaking of bad neighbors, I don't know what the heck you can do with media other than get out of it. David Zaslav, excellent operator who's trying to turn Warner Brothers Discovery around, but it's a disaster. The company reported a miserable quarter last night, taking a $9.1 billion write-down for some of its linear TV assets. It was just devastating. To which I say, of course it was. Linear television is facing cord cutting, escalating costs, and it's competing against a much better ad delivery system for reaching the right people, the AI-powered Meta platforms. You have no idea who's watching linear TV at all, right, or what their predilections might be. But when Meta places an ad in people's Instagram feed, it'll be something very relevant to them because Meta already knows what you like, maybe even better than you do. You can't beat them. It's like when I worked for the Tallahassee Democrat when I got out of college, and we were grateful our paper came out in the morning because the television news had eviscerated the evening papers. That's what it feels happening to linear TV versus the well-financed hyperscalers. Nobody can compete. There are terrible neighborhoods all over the map right now, even in update fast food, right? It's become very tough because there was too much pricing being taken by members of the group that colors all the rest of them. Drugstores. Oh, man, how tough. Because Amazon's coming after mall stores like Gap, which is turning around, get hurt because the vast preponderance of mall-based retailers can't get any respect. Terrible neighborhood. The moral of the story, do not fight the map. A bad neighborhood cannot be bucked. It doesn't matter if you think your company will be the one that triumphs over the other houses on the street or not. Forget about it. Go find another stock, one that's in a good neighborhood where Wall Street's willing to give them the benefit of the doubt. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.